Hello and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. I am your host Pushpendra Mehta, executive writer at CTMfile.com. Joining me today are Bob Stark, Global Head of Market Strategy at Kyriba, and Paul Galloway, Senior Advisor at Strategic Treasurer. It's time to get some deeper insights from you on our themes for today, namely payments, rising costs and technology, treasurer recruitment, cybercrime, and currency volatility and management. You can read these articles and also research content more deeply by visiting ctmfile.com or by following the links in our show notes. Our first theme for today is about payments. The global payments sector is expected to reach nearly US $848 billion by 2027, stated the recent Payments Worldwide Market Report 2023. Asia Pacific was the largest region in the payments market in 2022. There are a number of areas within wholesale payments like real-time payments, cross-border payments, embedded payments, and central bank digital currencies that are expected to have a significant influence over the payments landscape within the next few years. According to you, Bob, in the Global Payments Sector Report, what is it that you find most interesting, and what, according to you, will be the top 2 or 3 payment areas that will impact corporate treasury the most within the next 2 to 3 years?
Yeah, it's a great question. I always like numbers like in this report for the simple reason that it helps us understand that A, payments industry is growing, and B2B as a segment of that is also growing as well. I liked the note around APAC is a disproportionate amount of that growth. That's in line with what we're seeing in general around payments, but also specifically for the subset that focuses on corporates and corporate treasury, because we do see more digitization in APAC than we do in other regions. Now, that said, what does it mean for treasury that the payments industry, the payments market is growing? I think what it really means, and this goes back to your second question, is that number one, we have an impact of digital payments. And faster digital payments, I should say. So that's one theme that I don't think is very, surprising to anyone that would be listening to this, is that we're moving away from things like checks in the United States. We're moving away from older style payments and moving more towards instant and faster payments. So that's point number one. Point number 2, I think, is the more interesting piece, though, and that's where we look at embedded payments. Embedded payments, in terms of what we expect in 2023, will be a big percentage increase year over year. Now, it's a very small piece of this overall number. We're not talking it's 50% of this 800 billion. It's a much, much, much more minute piece. Paul, certainly you'd have some thoughts on this as well. This idea of embedding this within workflows, within say simple things like I need to pay my suppliers, but now that I have this as part of an embedded communication in response to a message that they said, can you pay this right now? They sent me an email, the payment request is embedded within that. And then it's a matter of execute on that and then having all these different systems that support that integrated via API to support an end-to-end experience. There's a whole conversation there, more than the answer you're looking for today, but there's an incredible amount of innovation that is there right for corporate treasury to take advantage of as we see growth across the industry, but also in these subsets.
Yeah, Bob, I think you make some really good points around direction of where payments is going and probably where the future is going to land. Certainly, one thing that I was doing before I came to Strategic Treasurer was trying to push our company away from checks, but it was really difficult for the industry we were in. We have a lot of customers that are of a generation that they like checks. They like to receive checks. They like to pay with checks. So I do see checks kind of hanging around longer than I want. But what I like seeing is the adoption of new technologies to make payments. new ways to do it, more contactless, more seamless. I do think there is some upside to the embedded payments option. That is something that companies, I think, over time will get more and more comfortable with. Obviously, the potential for fraud and how you mitigate that is something that's going to be high on their list of priorities before they adopt. But that's definitely something that I can see making more headway as technology advances and we get more and more secure ways or rails for making payments. And so, this is exciting stuff. I like to see the use of new technologies. The ability to do contactless payments for myself, just going into a gas station and just put my card against the pump and I can pump gas. I don't have to do anything more than that. I like that. I don't like writing checks. I never have. And I stopped writing checks as soon as I could set up all my payments in my bank account to be automatic. I was like, great, I never have to write a check again. It's once in a blue moon I might have to write a check, but otherwise I don't. Adoption of these new methods is going to become more and more prevalent.
One interesting thing that I was sort of, I don't want to say buried in the bottom, but it was the very last part of this excerpt of the article was, and you touched on it, Paul, was around security. The reference was biometric authentication is gaining traction in the payments industry. I say thank goodness for that, because the ability to recognize, Paul, you mentioned this a moment ago, the ability as we digitize payments to ensure that we increase, not just keep in line, but increase the level of controls to protect so that as payment fraud schemes, however they manifest themselves, are actually more controlled and more predictable in advance. That is critical. And I'll just use one example. The biggest craze in the digital world or in the search world is ChatGPT, right? Generative AI. This is being used already to improve the authenticity and the complexity, like the linguistic complexity of fraud schemes, both on the consumer side and the payment side, or the B2B side. So being able to run your process fully digitized, but also at machine speed to be able to assess fraud threats and be able to recognize when payments are out of policy, to your point, Paul, that's the sort of thing that needs to be happening. So you can't run AI against a check writing process. There's too many broken pieces that are manual in nature. So as you go digital, as you go real time, you need to ensure that the process is not just catching up, but getting ahead so that you increase that level of security, not just maintain it, but increase it.
Yeah, spot on, Bob.
Bob, you and Paul made some very interesting points. One about contactless payments that Paul spoke about, and Bob, you spoke about biometric authentication. If I can ask you a follow-up question, biometrics have been around for a while. Are decision makers, be it business leaders, CFOs, treasurers, strategists like yourself, and other executives in the upper echelons, do they have concerns around privacy and security when it comes to adoption of biometrics?
Yeah, that's an interesting point. It's a very different answer for, we'll call it P2P payments versus B2B. If you're looking at more on the consumer side, most of these payments, most of this growth is through mobile. Generally in Treasury, you're typically not using your phone for that many things. You're using your laptop, you're using your Mac, you're using some sort of more larger device than just a phone. So integrating that phone and the biometric capabilities that go with it, with your other hardware and into your process is a bit of a mind shift. Paul, I'm sure in your experience, we're doing stuff on our laptop, but we weren't necessarily bringing our phone to add those extra levels of security. That is a mindset that needs to be changed and solved. There's capabilities that, whether it's your thumbprint, whether it's your eye, like with your iPhone as an example, where that unlocks it. These are the sorts of second factors of authentication that are absolutely critical to B2B payments. And I say absolutely critical. It's not just a nice to have, or you really should do that. We need this to be integrated into a workflow so that we are absolutely sure that the individuals that are creating those payments are authorized to do so and the individuals approving those payments and reviewing those payments and checking for fraud, all of those different pieces to the process are authenticated in the journey.
Yeah, Bob, I think the biometrics and the use of phones or other applications, I mean, as soon as I could get a soft token on my phone and get rid of bank fobs, I was all for it. Then you have third parties such as Kyriba or even banks that offer the ability to use your phone to transact business. I think that's the future where we're going to go. But having that biometric capability where it's your thumbprint, it's your eye print, it's the kind of thing that is unique to you for authentication and approval of payments, movement of cash, can help mitigate the issues of fraud. Let's face it, fraudsters are becoming more and more sophisticated in what they do. And it gets more and more difficult to determine whether you have something that's legit or not. People aren't paying close attention. I see it every day in my personal email accounts. It's literally like every day I get phishing attacks, and it's like crazy stuff. Yeah, no, I don't remember ever having a Costco membership, but man, I get stuff from Costco all the time now. And it's like, I don't even have a membership. So they're trying all kinds of ways, PayPal, Home Depot, Lowe's. I mean, all these places that are large, well-known names in the US, they're trying all kinds of ways to get you to click on something you shouldn't. Well, it goes the same way for a business. I can tell you when, I was a treasurer over at a company, and I would get emails on a regular basis that, you start looking at them, you're like, wow, this doesn't seem quite right. And sure enough, 9 times out of 10, they weren't. You'd send them to your IT folks as phishing, and they were. And that's kind of scary. You get somebody that's just not paying attention close enough, and they click on something, and the next thing you know, you got an issue. Any way you can mitigate that, boy, I'm in favor of that.
Technology and emerging technology, I guess, the way out. Those are great insights. Moving on to the next story that pertains to CFOs viewing inflation and cost of capital as the top 2 risks facing their businesses as they prepare for slower growth over the next 18 months, according to findings from a new survey conducted by FTI Consulting in collaboration with the finance publication CFO Dive. Given the inflationary environment and rising interest rates, Bob, do you think growing investments in finance technology and automation can be the differentiating factor that can help corporations manage revenue pipeline and enterprise costs prudently?
Yeah, I guess there's a couple of different answers to this. I'll start out with first things first. Every treasurer, especially in North America, but globally as well, they're utilizing the higher yields that come from the rise in interest rates to be able to reduce their vulnerability to inflation. Obviously, if you look at, say, savings at 3.25%, 4.25%, depending on the region, you're going to find that that's nice, and it's a lot higher than it was a year ago, but it still doesn't offset inflation. So the key strategy here from a treasury perspective is that unlock as much possible cash as you can, whether that's hidden in bank accounts that are maybe underutilized, whether it's within your cash conversion cycle where you're not optimizing DPO or DSO and you're leaving money on the table, so to speak, there. Be able to wring every element of it, efficiency out of your cash conversion cycle so that you can actually deploy, even if it's just on a short-term basis, to reduce that effect of inflation and rising rates on your cost of capital. So that's part one, but that's not really the big answer to your question. The big answer is CFOs have to be able to understand with precision what the actual impacts of inflation and rising costs are going to be. Are they in a position where they have to borrow? If so, are they borrowing more than they really need to? What is the, it kind of starts with that cash forecast, that liquidity plan, being able to rely on that absolutely 100%, not just for the next 30 days or 60 days or 90 days, but looking out months and even up to a year plus in duration. You have to be able to do those things so that a CFO can pull the right levers to support the business. And it's that kind of partnership that Treasury has had but there's a much greater reliance on Treasury, Paul, I think you would probably agree, than what we've seen in other times. And so the Treasurer has a spotlight on them where they're providing and delivering an incredibly valuable tool. Not saying that the forecast wasn't valuable before, but the emphasis on that to predict and optimize free cash flow has heightened in the past couple of years, which I think all of us in Treasury would say is a good thing.
Yeah, I think there's a couple of things going on here, Bob, you've hit on. Inflation is definitely problematic for CFOs, treasurers at organizations, especially around two things. Well, it's kind of a double-edged sword. One, your cost of capital is increasing as rates increase. And then at the same time, your point on getting cash, putting it to work sooner, putting it to work at higher returns or higher yields on that cash to offset the inflation is a challenge for sure. It helps that rates are increasing though. So that does help them. Inflation needs to be coming down at the same time because your real rate, either whether you're looking at cost of capital or you're looking at your return on your investment, you're getting hit on both ends. And so if inflation is coming down in a rising rate environment, that will help you with your real returns on your investments. But if interest rates are continuing to rise, your cost of capital is increasing at the same time. So you got this double-edged sword that you got to solve for. And that can be challenging. So if CFOs and treasurers have not been looking at their options to raise capital, either on a contingent basis or otherwise, they're kind of behind the eight ball already. They should be doing that and doing that now. There's no doubt in my mind we're going to have more interest rate hikes this year. The question is how many more and how much? I have a fear that inflation is going to be sticking around at kind of the level it's at for a little bit longer than maybe what we anticipate. But that all depends on, what the Fed continues to do and what happens on a global economic basis. I think CFOs have been looking at their options for raising capital. So the question is, how can they position themselves to take advantage of what's going on in the markets with rising rates and hopefully falling inflation. It's technology that can help you optimize, as you talked about earlier, Bob, optimization of your cash, meaning you're not leaving on the table in your bank accounts longer than it needs to be. You're getting it moved and put to work as soon as possible. The forecasting piece, the understanding of what are my cash flows going to be over the next, 12 months versus just the next week or next 30 days. They're going to look at, what's my cash flows going to look like over the next 12 months? And do we have technology such as machine learning, artificial intelligence that can help us be better at forecasting and positioning our cash ahead of time, making sure I have what I need in place prior to when I need it, but only pull the trigger at the point when I absolutely need it. So you're optimizing the flow of that cash, drawing down on cash when you need it, putting cash to work when you don't need it. It's technology can help people do that.
Those are valuable insights, gentlemen. Moving from technology to our next story that revolves around treasurer recruitment and the article, How to Find Your Next Treasurer, which was published on CTMfile. Given that there is an increasing shortage of treasurers and an enormous churn in the treasury job market, as was evinced in this study by Cobase, which is titled The Hidden Gems, the Subtle Art of Finding Your Next Treasurer, where they say that finding a suitable treasurer is quite a challenge, although they must be there. As a matter of fact, over half of the FTSE 20 non-financial corporates have seen a change of group treasurer in the past 18 months, as per the Association of Corporate Treasurers Business of Treasury 2022 report. Given what you know of corporate treasury, Paul, do you have any recommendations that can help companies find the right treasurer?
Boy, I wish I had a crystal ball for that, Push, but I think the article really kind of hit on what organizations need to think about or consider when they're writing a profile for a job in the Treasury arena, especially for treasurers. A treasurer at one organization may not work at another for various reasons. Every company has a different, they have different profiles in terms of how they do business, what their balance sheets look like, product lines that they have that drive revenue, cost profiles. They're just different. And so there are different skill sets needed from a treasurer for different organizations. Some organizations may be U.S. domiciled only. Some may be international platform and they're trading and doing business in all kinds of different currencies. And they have banks all over the world. If you have somebody that doesn't have experience in dealing with that, they wouldn't be a good fit for an organization that needs a treasurer that has a global footprint capability. So I think it's assessing what the real needs are for the organization so that the profile hits the mark in terms of what the company needs for skill sets. Then I think what the article hit on next is also important. How do you attract them to your organization? So you need to make it attractive for the person that's going to enter that role to come or want to explore the opportunity with the organization. So there is some setting the tone in the profile beyond just the job requirements to ensure that the potential candidate or potential treasurer knows that the organization has certain benefits to it that are either tangible or intangible that will attract a person to that role. So it's not easy. I do see on LinkedIn, roles that pop up all the time for treasurer. So there's a huge demand out there for them. And I can see that it's definitely an issue for organizations to find quality talent that fits the needs of the company in a treasury, or treasurer capacity. Definitely a big challenge.
Bob, would love your thoughts.
Absolutely. I love this article. And actually, there's a couple of different things that are referenced, ACT as well as the Cobase article as well. It's an I told you so moment. Everyone in Treasury knows that Treasury is really hard. And it became harder with the transformative needs that organizations have. Their expectations of Treasury have increased. That complexity is right on display here because, as Paul just said, there's a lot of different profiles and it's not easy. Nothing's easy in terms of Treasury, but there's an element of complexity and experience to drive that level of transformation. I mean, in the previous segment, we were talking about looking at recomposing your balance sheet around the level of cash, being able to find different ways to actually look at capital versus cash conversion. These are not simple things. And the expectations of Treasury is not just to look at how much cash do I have in my bank account today and how much am I going to have in 30 days. It's a very different process around liquidity and capital planning, in addition to a variety of other extensions when you get into international that push the boundaries of most treasurers. And because the expectations have increased, the spotlight has increased, and it's harder to find those people that have done it and have that vision for what next looks like. There's nothing simple about this. And so I look at this with a smile and say, yep, Treasury is hard. And now that organizations, especially CFOs and CEOs, are waking up to the idea that there's a tremendous amount of value to be unlocked here, it is an impetus to be able to recruit a little bit differently to support those transformative needs.
Yeah, Bob, I think you hit the nail on the head in terms of the diversity in the treasurer role. It's a lot more complex. It's not just managing cash or cash management. It's capital management, it's liquidity management, it's hedging programs, it's securities lending programs, it's dealing with revolvers, it's raising capital, these investing. There's investing components. And then we haven't even talked about the strategic aspects or demands on Treasury. And that didn't used to be a thing, but it is now. And so demands or expectations of the treasurer role is expanded quite a bit. So you need people that have certain skill sets in these roles today. And it's not easy to find a person that fits that. There's just not a lot of people out there. And so it's becoming more and more difficult for organizations to find these people that they need. It's a challenge.
Moving on from one challenge, which is the finding a suitable treasurer, to managing the increasing complexities of cybercrime, which now seems to be directed against corporate executives and board members. Our next theme for today's discussion is a surge in swatting threats against corporate executives and board members. Swatting is falsely reporting a violent crime such as a fake bomb threat, murder, shooting, or hostage crisis to the police to persuade them to send a well-armed special weapons and tactics team to the targeted location or site, which can be an unsuspected home or workplace. This is on the rise in corporate America. Swatting has affected cybersecurity journalists, politicians, and celebrities, among other groups. And now, according to digital executive protection company BlackCloak, swatting incidents are reaching the top rank of Fortune 500 companies, with malicious actors targeting C-suite executives and corporate board members. Dr. Chris Pearson, CEO and co-founder of BlackCloak, makes an important statement when he says that cyber criminals are using everything at their disposal to cause havoc and disrupt the security of corporate executives and board members in an effort to get to the bigger prize, which is corporate assets. Given that BlackCloak is alerting corporate America to a phenomenon that has accelerated over the past 5 or 6 weeks, Bob, are you concerned from a corporate treasury perspective, given that corporate treasury is considered the steward for financial risk management? What do you think can be done can you recommend 1 or 2 methods or measures to lower swatting risks?
Well, firstly, yes. I mean, this is horrifying. Unfortunately, it's probably not unexpected. I mean, swatting is a phenomenon that is much beyond the corporate executive within Fortune 1000 organizations within America. I mean, this happens at a pure level within high school as well. Like, this is not new in general, but the extension as we'll call it a blackmail type scheme, or an effect to try and unlock ransomware, is part of the many risks that finance teams have to deal with. And it's not obviously just finance, it's finance in partnership with the CISO within an organization to try and put up effective boundaries. One of those things, and I think this was one of the main points in the story, was that there's a lot of information out there. You think of as a CFO within a Fortune 1000 organization, you think, why would someone target me? Well, because, to your point, pushing the question, you are the steward, if you're the CFO, of the assets. You're the one that might think, oh my goodness, there's a SWAT team outside my house. If it's that dire, I need to do something right now. And you're the one that can actually have the buttons to make something happen in terms of directing payments or Bitcoin ransomware or whatever it looks like. Point is that there's a lot of information out there. Limiting the amount of information that is available is one of those recipes to help limit the possibility that this happens in the first place. That's part of it. Now, that's the CFO, though, because the CFO is typically a listed officer of the organization, at least for publicly traded organizations. Right. Treasury typically doesn't have that name recognition. Most fraudsters, cyber criminals aren't necessarily going to have the list of the Treasury team at their disposal. Not to say that information can't be found, but typically they're not going to have that, and they're not going to have the ability to triangulate that against other data that would allow this to be successful. And in fairness, the treasurer, it's not like they're the chief liquidity officer in the organization. They don't typically have that title and that awareness outside their organizations. So does it mean that Treasury shouldn't be concerned? No, it doesn't mean that at all. I mean, this is a phenomenon and a trend that is continuing all over the place, but they're probably less at risk than those that are listed officers of the organization that might have more information out there and more of an attractiveness around how much of a target that they are. But Paul, I mean, you've been a treasurer. What do you think?
Yeah, I've headed up a treasury team. And so when I came to the company at the time, the CFO also held the title treasurer. And I can tell you from experience here where I live, we're one of the insurance capitals in the U.S. There's a lot of insurance companies. A lot of these insurance companies have named their CFO also treasurer. And so it doesn't mean that they're a true treasurer, though. In some cases, they hold the title, but they wouldn't necessarily say, oh, I'm a treasurer, even though they technically are. It's one of those things where people have access to LinkedIn, and they can go out to LinkedIn and they can do searches. So LinkedIn is a professional, social media site, and we use it as strategic treasurer all the time. And I've always had, my titles to all the roles that I've had. Just reading this article and kind of rethinking, geez, should I change the way my profile looks on LinkedIn even? Is that something that you should do? It was interesting in the article, Blacklock made this comment around, well, if you're going to buy a house, that you register it in, a trust or some other name, but not your own name. I don't know how you actually legally do that. Maybe there's a way to do that. I just thought that was interesting. So, I think executives definitely have to take a step back and think about, okay, what are all the touch points where they might get information on myself or others on my executive team to try to hold us hostage and make us do something that we don't want to do, which is release, corporate goods, cash to somebody. Kind of an emotional thing when you've got a bomb threat or something else that is made and you have a SWAT team right there and you're getting pressure and you have to make a decision. That's really scary to think about. It's something that I don't like hearing about. I don't like that it's there, but it's there. So I think treasurers and CFOs, man, I think organizations just writ large, I think we got to rethink how we state what we're doing, make it more difficult for fraudsters to find out who we are, where we are.
Yeah, you know what, Paul? The one thing I would add to that, because you really exposed this quite well, is that you can reduce the possibility of this kind of happening by data protection, those sorts of things. But we know in reality that there's always ways. Should you be a target? Obviously, that's the proviso here. Having in Treasury, and Treasury should be leading this in concert with other leaders within the organization, a crisis response plan that includes what if this happens. Typically, your chief information security officer, your CISO, will have some elements of plans for the organization. What happens if we're in retail? What happens if our point of sale systems are shut down? What happens if we're unable to access the systems to trade? The thing goes on. There's so many different examples out there. Treasury needs to ensure that their part of this is represented and not scripted by someone else, so that the ability, if that needs to happen, if that's what the corporate mandate is to respond to certain types of cybercrime, is to release funds. If that's part of the plan, I'm not advocating that it should be, but if it is, then how that happens, and it needs to happen in a certain time frame. So there needs to be an SLA around response and around financial response, practically speaking, because there's going to be some scenarios that have to be managed swiftly. And you need to know what that looks like, as opposed to think, oh goodness, how should we do this? Okay, let's mobilize. Let's mobilize is after the fact is not good enough. Treasury needs to be part of that strategic planning to ensure what if this, what if that the plans all the way through to financial mobility are in place.
Yeah, that's a really good point, Bob. If you don't plan for something or think about the different scenarios that could exist out there, do your research and understand and know the tactics that are being taken out there, your response is going to be poor relative to having knowledge and a plan in place. So I think that's a great point.
And I couldn't agree more. I think it's extremely important to have a crisis communication plan, as you mentioned, Bob, in particularly for the growing surge in swatting and what to do with it when it happens and if it happens in the scenario analysis that Paul spoke about. Moving on to our next story for today, which is about something that is of particular interest to me, given that I've written about it. And, it's also a very important element of corporate treasury, which is about Kyriba's currency impact report, a comprehensive quarterly report that was released recently, which details the impacts of foreign exchange exposures among 1,200 multinational companies based in North America and Europe, with at least 15% of their revenue coming from overseas. The report says that, these corporations have sustained US $64.22 billion in total impacts to earnings from currency volatility. The Kyriba report says that the combined pool of corporations reported $47.18 billion in headwinds and $17.04 billion in tailwinds in the third quarter of 2022. Bob, can you tell us more about this report, and do you expect more currency volatility in 2023? In particular, do you think US corporations and sectors will continue to remain vulnerable to the soaring dollar?
So I'll start with it. I'll just say yes, but I'll give you more than that, Push. Yes, all of the bad things in terms of volatility in currency markets are going to continue, but the composition of where those challenges are going to be will be slightly different in 2023. But going back to your first question, in terms of the currency impact report, it's a quarterly report that we produce at Kyriba. We've done so for the last 8 years. Okay. And certainly in 2022, especially in Q2 and Q3, we saw the most significant US headwinds, especially at pace, which coincided with also the most rapid increase in interest rates by the Fed. They went hand in hand together because, as we know, currency rates are a function of the interest rate differential. And the US rose or increased rates faster than anyone else did. And as a result, the dollar rose faster against the euro and other basket of currencies than we'd seen in a long, long, long time. So what did that mean? It means currency headwinds for American organizations, or tailwinds if you're not an American organization and exposed to the US dollar. There's no surprise in this. We all saw what happened. The US went above the euro, and so parity, that line was breached. Since then, it's maybe, I don't want to say returned to normal, but it's settled a little bit in terms of Q4 and into Q1 of 2023. That story is very predictable. If there's a strong dollar, it's very difficult for American organizations that are heavily exposed to other currencies, because suddenly the value of those currencies, your cash flows in euro, your cash flow in sterling, just got a lot less valuable, and it's a big impact to your earnings. While that's the storyline, the biggest impact is the volatility. And that's the storyline that continues in 2023. As relatively speaking, the dollar has become less strong to other currencies, which is really not the dollar becoming less strong, it's the other currencies strengthening and catching up a little bit. The volatility has continued, and this is what's really difficult for Treasury. Dealing with headwinds or tailwinds, those are challenging, but it's what happens on the day that you're looking to maybe report or translate your financial statements, the day that you're looking to get a significant amount of cash flows in, or drive revenue or drive earnings. It's that what happens today, what does that roller coaster look like? Am I on the top? Am I on the bottom? Am I going one direction or the other? For those that either need to report impacts, so for translation, or those that actually are looking to hedge some of those exposures, volatility is your enemy. And that volatility, what we saw in Q4, so even as the dollar was starting to soften relatively, we saw the FX VIX, which is a index that I really like to follow because it gives a really nice picture of what's going on. We saw the FX VIX again at all-time highs, comparable to when we saw the dollar at its strongest point middle of last year. What does that mean, Push? Well, there's a whole webinar we could do on it. The really short version is that it became very expensive to hedge within the certain guidelines and rules that we're trying to work within and policies we're trying to work within. So it meant that to stay within budget and be able to limit the amount of P&L associated with currency, you had to extend a lot more, either in options, a much higher premium, and forwards, you weren't able to get the rate that you wanted, or you had to pay on the other side of that. You weren't able to protect the level you needed to. And that's why we had a lot of organizations report these excessive headwinds and noise in their financial statements. No CFO wants to be talking about currency. That's why they invented things like constant currency reporting, so that they don't have to talk about it. They can just punt that till later. But when the later comes, which is where we are in 2023, you still need to have some sort of answer. And hedging, if you are in a position where your policy allows you to do that, is harder. And it's going to be harder throughout 2023 as we see more and more volatility, even as the euro regains some of its footing, as the yen starts to increase. We see China starting to make some movements, even though it's relatively pegged. There's a lot of things that are really, really challenging to deal with when it comes to volatility. The headwinds and the tailwinds, well, Bloomberg and Wall Street Journal and all them, they're very tantalized by that for all the good reasons. They're big numbers. The volatility is what causes Treasury nightmares.
I think volatility of currency is not done this year. I think we're going to continue to see some additional movement in the dollar up and down. It's not just the U.S. It's a global issue right now across the board when it comes to inflation. We have a lot of social, political aspects that are also impacting that. War in Ukraine, continued friction with China. We're seeing that there's some issues that continue to persist. There's switching in terms of supply chain to try to mitigate some of that, but we're still in a fight mode, still fighting inflation. Not just in the U.S., but abroad. And that has an impact on our currency. The other thing that I think also has an impact on U.S. dollars is there's a lot of U.S. dollar denominated debt out there. There could be, in essence, it's kind of like we have a short on dollars in place with all this existing debt that's out there. When that debt comes due, or at a time when corporations or sovereign nations that hold U.S. denominated bonds have a call on dollars to pay these things off, we could see a big shift in the U.S. dollar if that was ever to happen. So I think we've got, a couple things out there that are just going to continue to persist from a FX volatility standpoint. So then, to your point, Bob, how do you effectively manage or hedge your currency risk? And it's not the same for every company, right? There are some companies, they don't have a lot of FX exposure. And then there's a lot of companies that do have a lot of FX exposure. The way that you would approach your hedging may be different. One company may fully hedge. Another company may partially hedge, depending on what currency they see as the biggest risk. The problem in this FX volatility environment, it's quite, determining what is the right hedge to put in place. So it makes it much more challenging. You can use technology to help you with some of that. I think it's tough slogging. It's going to be a tough year from a currency exposure standpoint. So, there really isn't a great answer, even if U.S.-based companies that have foreign cash sitting in foreign banks decide to just let it sit there. There's still a translation cost that occurs. So there's still that impact nonetheless. So hedge, don't hedge, repatriate, don't repatriate. What do you do? It's a conundrum for some folks. It's not easy.
What is your choice for the biggest or most important story of the past week, and why? Paul, if I may ask you to answer that first.
Yeah, I think one of the most important stories hit this morning when Vladimir Putin came out and said that he was going to withdraw from the nuclear arms treaty with the U.S. I think that's a really telling sign in terms of what Russia is positioning themselves to do or continue to do. I find it very concerning. It feels like, between our issues with Russia and also, issues with China they've gotten worse, with the downing of the balloon a few weeks ago. It feels like we're entering into probably a new Cold War. Hopefully it just remains as a Cold War. The issue in Ukraine doesn't become more expanded. But there's also, I read a report that was leaked. There was a leaked document from Russia with intent to, quote unquote, I don't remember the exact term that they used, but it sounds like they have a plan in place to basically annex Belarus and make them part of Russia. So it's really concerning to hear these things. I think it's a significant story that people can't ignore.
Here's the way that I look at the news is that there's some themes that are recurring. Every time we look at the financial, or we look at global news and we see the events that are happening, they are continuing to push that word that we used in the last segment, volatility. Mm-hmm. And the volatility has, you look at from the pandemic to political tensions of many different kinds throughout the world, they all push volatility in financial markets. And that volatility has a response. So when there's higher inflation because supply chains are challenged, that necessitates a reaction. And a lot of times raising interest rates is that reaction. That has a compounding effect on CFOs and treasurers when we talk about things like, how do I deal with inflation? How do I deal with rising interest rates? How do I deal with currency volatility like we just spoke about? Mm-hmm. That underlying theme, what we saw in 2022 and what we're seeing in 2023 is that theme of volatility wreaks havoc with the predictive plans of CFOs and treasurers. And to me, it's not just the story. It's what underlies at least half of our dialogue in this podcast and the stories you put out there. Absolutely. Is how do you deal with this multitude of factors? You have to have a different set of strategies, tactics, data, and tools to be able to deal with this new reality, which is a very volatile economic world.
Thank you so much, Bob and Paul, for your informative analysis and insights. We would also like to thank our CTMfile audience for joining us on this edition of Open Treasury. Please subscribe and look in the show notes for the article links. Thank you so much. This podcast is provided for information purposes only, and statements made by CTMfile or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.